Good afternoon, guys. Hope you're all well. Let's tee up the US session, Wednesday, 18th of August. And an unusual day yesterday. Quite some interesting movements in the markets. At the time, it was one of those events where you're a little bit confused as to the reasons why the direction is the way it is. But we've got a pretty good explanation for it now, and it's something we can use actually with a bit of luck. In fact, starting tomorrow and then a couple of other occasions this month. So let me go through what happened yesterday. If you have a look at my charts here, I've got the S&P on the top. This is yesterday's session, okay? I've got oil on the bottom left and I've got euro dollar bottom right. So let's just talk through what happened yesterday. First of all, the first part of the session, stocks were in a very tight range going into the 130 economic data. And so 130 economic data is here, and you can actually see a nice blue candle on my equity market chart here. So, you know, if you were just going off theory, you'd expect that the 130 housing data was good news, and stocks went bid. But actually, when you look at the announcements, the data was bad news. So further housing market bad news and disappointment. So why did stocks go bid? And you have to move down to the euro dollar chart to explain why. So here, 130, when the data came out, what we saw was dollar weakening. Okay, so the dollar weakened off the back of bad US housing data. That dollar weakness created upside for risk assets. This is the reverse sort of flight to quality situation that we had last week. Because last week we had dollar strength and we had stocks weakness and crude weakness, that correlation's pretty high at the moment. So when you get the scenario that the dollar weakens off the bad economic data from the US, risk assets find it really difficult to go lower, okay, even though it's bad news. So actually what we saw at 130 yesterday was equities moving higher, okay, and staying within the range. So it confirmed the bottom of the range quite nicely. We moved straight up to the top of the range, which again got confirmed quite nicely going off that high from earlier on. Then we drifted into the cash open. In fact, actually before the cash open, sorry, we had the industrial production numbers. And if you look at the chart here, you can see a nice red candle at 2:15 yesterday. So of course, going off theory, you'd think that the industrial production numbers were bad news, okay? But when you look at the announcement, you'll find that actually it was good news. So we got the exact opposite reaction in stock markets yesterday than you would have thought, okay? And this is really due to the dollar. Again, look at 2:15 on the euro dollar. We got dollar strength off the back of the good industrial production numbers, okay? This led to risk assets moving lower. So in quiet markets in August, what you'll find is actually there's one particular factor that will drive markets, and it doesn't necessarily add up to what theory would tell you. So the dollar was really shaping a lot of the movement yesterday, and that movement was very counterintuitive, which made it very difficult for us to trade, of course. So you've got to be aware of the dollar, especially in quiet markets like this, guys. It seems to be dictating things at the moment. Okay, cash market open yesterday, 2:30, big sell-off. Well, I say big sell-off. Got down to 1066.25. Okay, then I want to talk about the other major event yesterday and the move that actually, you know, caught us out. And it was really the big sell-off. If you have a look at the euro dollar down here, because of the correlations earlier on being so strong, we got quite a large sell-off in the euro dollar between 3 o'clock through to about 3:45. Okay, big sell-off in the euro dollar, that strengthening dollar. Therefore, given the correlation from earlier on in the day, you would assume stock markets to also sell off. Here we're looking at the chart at 3 o'clock. Okay, so 3 o'clock in the stocks, we actually started to move higher, even though the dollar was strengthening and euro dollar was moving lower. Let's look at oil. Same, oil sold off from 3 o'clock as well. So we had oil and euro dollar selling off, quite strong sell-offs between 3 o'clock and 3:45 yesterday. With the correlations, this should have led to a sell-off in stocks. However, that didn't happen. And what we actually saw was the exact opposite, in that we saw a complete reversal in euro dollar and an even stronger reversal in oil. Oil went from the low of the day at 335, ramping up to the high of the day just 30 minutes later. And we had a complete reversal in the euro dollar as well. So rather than stocks following oil and euro dollar lower, those sell-offs in oil and euro dollar got completely reversed, and equities actually marched up through the highs and went on to set new highs. Now, why did this happen? Just hang on one sec, guys. I think I've got a problem with my chart here. Okay, so let's talk about this 3 o'clock move. Here we go. So the 3 o'clock move in equities is 345. Okay, this is important because it may well happen again tomorrow, and it may well happen again next week. Why did equities go higher from 345 onwards yesterday, in the face of a big sell-off in the euro dollar and in oil? And the reason for this is it's the first of what was the Federal Reserve's permanent open market operations. Okay, so this is following on from the quantitative easing announcement that we had last week that actually led to that huge flight to quality sell-off on Wednesday. Well, actually, the first operation was yesterday. And what happened here, with the help of various sell-side analysts, basically primary dealers knew precisely which treasuries to purchase in advance of the auction, and therefore they got a quick leveraged pick up of a couple of hundred basis points. Now, this money was funded back to them at the end of this permanent open market operation yesterday at 4 o'clock. Okay, so at 4 p.m. these primary dealers got their funds back from that open market operation, and they got their profits back. And where do they park those profits? They park them into risk assets. Okay, so that's why from really 4 o'clock onwards equities ramped higher, and we saw a complete reversal in other risk assets such as oil and such as the dollar. Okay, and equities actually went on to almost touch, well, pretty much get to our second target yesterday, which was right up at 1098.50, just a couple of ticks shy of one of our key levels that I'm going to talk about in a minute. So the reason for the complete reversal, the reason for the ramp higher in equities yesterday was nothing to do with economic data, not really anything to do with sentiment either. I mean, sentiment was better yesterday, but it didn't suggest a move up to 1100. So it was the first of these Fed's permanent open market operations leading to a bit of risk appetite from the primary dealers. Now we've got the same event happening tomorrow. Okay, so tomorrow around about 4 o'clock we'll be looking out for a similar move. There's also open market operations scheduled for the 24th of August and the 26th of August and the 1st of September. This is an event and a scenario that we kind of got used to last year when quantitative easing was very regular, but we're not used to it now, and so that caught a lot of market participants by surprise yesterday. And we won't be caught by surprise on Thursday. We're going to be interested to see if a similar risk appetite suddenly appears at around about 4 o'clock, and if it does, we won't be surprised. So an unusual day yesterday, guys, and at the time was a difficult one to explain, but this is the reason why. It's the quantitative easing and the primary dealers basically having to put funds somewhere and choosing to put them in risk assets. Okay, alright, let's move on to today. I just want to zoom out a little bit. Let's look at our 1 hour chart on the S&P, because you can see what happened yesterday. That risk asset push from the quantitative easing pushed us right up to 1098.50. Okay, so that's yesterday's high. That's actually our first target for today, but it's just shy of 1100. This has now broken us out of the channel we'd been in since the big sell-off on Wednesday, the flight to quality sell-off last week. We'd basically been sideways to slightly lower. Okay, yesterday reversed that, and we retraced a good portion of it. Okay, now we did get a bit of a sell-off into the close, which gave some of that profit back, but ultimately now we're back above a level that I don't have a line on here for. A level at 1089, which was the high on the on Friday. Friday's high, we're kind of back above that with the pivot in there as well, kind of messing things up a bit. But we did give back some of that profit last night. Now this morning, we're neutral today now on markets. Given the moves that we saw yesterday, we're neutral for equities because there's no economic data at all today. Okay, so we're neutral. We think we may well just consolidate what happened yesterday. We've got an entry point long at 1084.50, which is the low of the day from the European cash open. And we've got modest expectations. I don't think we're going to get above 1100 today, but our first target's yesterday's high, and our second target is a key resistance. It was the low on the 6th of August at 1103.75. Okay, so we think it might be a quiet session. We've got some important data tomorrow, and we've got that second Fed's permanent open market operation as well.